Thank you for joining us for our first video of this year, covering the events of the last quarter. With me is Paul Hutchinson from 91. Paul, thank you very much for joining me. In my mind, this market events can be characterized as disruption and chaos. And if you look at it, what's happened in March, oil was up at one stage over 50%. The All Share was down nearly 14%. Gold was down nearly 12-13%. Platinum not far behind. Precious metals, our mining stocks were down at the height of this 29%. Bonds between 4 and 5%. So everywhere where you look, it's been, let's say, bloodshed. What do you make of what's been happening at the moment, and what's your view on this?
So it's fascinating, and thank you for the opportunity, Wayne. It's fascinating because it really is reflecting at its simplest level fear and greed. So if you cast your mind back just to the back end of last year, it was more of a greedy period. You had relatively low interest rates, the expectation for further rate cuts, you had economic growth relatively strong, you had a fantastic equity and bond market into the duration of 2025, oil price was low. Going into 2026, January and February, we actually had peak equity market returns on the 27th of Feb. So what's that, 25 days ago? And subsequent to that, President Trump unleashed an attack together with Israel on Iran, and I think we mustn't forget that there's real implications of that, and our thoughts and prayers to everybody that's affected. But it has introduced fear into financial markets, and it's most reflected, I think, if you cast your mind back to Monday of this week. On Monday morning, the markets collapsed 3%, so equities were down 3%. They closed up on the day. The rand went as weak as 17.20 and closed at 16.70. So you have markets vacillating between fear and greed as new information becomes available. And that new information isn't necessarily fact. It's just information that still needs to be acted on and still needs to reflect in policy. So I think we're in this significantly volatile environment. But we mustn't forget that we've come through this period where markets, interest rates, inflation were in a good space. We've now got this volatility, and there's an expectation that there is likely to be an end to what's happening in the Middle East. In which case, what is the probability that we see some type of reversal back to the period that we're experiencing the back end of last year into the first couple of months of 2026. Yeah. So I think the key message is it's impossible to act after the fact, or very difficult to act after the fact. And now it's really a question of looking through this phase and taking a more of a long-term view.
So obviously geopolitics and oil shocks, there's been many examples in the history of this happening before. Maybe if you can, I don't know if you can relate to some information in the past, but what's generally happened? Obviously, we learn from the past. We're not saying it's going to be the same, but markets have seen this. And generally, typically, how long does that last? And markets tend to look through that if we have settling environment.
Correct. That's certainly the experience. Markets look through it over time. A colleague of yours actually wrote a fantastic article on MoneyWork, Elka, and I wish I'd come up with a headline, and the headline was, the S&P 500 has never lost a war. And if you think about it, if you take a long-term chart of the US equity market or the South African All Share Index, it starts bottom left and finishes top right. And what you're seeing is an upward trending line. So over the long term, you're rewarded for taking risk, and that makes sense. There's an equity risk premium, so over time you would expect to get rewarded for it. And as a result, equity markets don't lose over the long term as a result of geopolitical actions, wars, etc. Individuals lose battles consistently through that period because they're acting at times when they potentially should be sitting on their hands and taking a longer term view and just riding through the volatility. And I think if history's taught us anything, unless your circumstances have changed, it's best to trust the process and hold the line and stay true to the plan that you had in place prior to the action. I read another fascinating piece, which really spoke to, if you haven't made a decision on the Friday, don't act on the Monday. Because what happens invariably is over the weekend, you submerge yourself in a lot of bad news. And then come Monday morning, you've gone through this period of just reading and analyzing a whole lot of bad news, and you act as a result at exactly the wrong time.
Yeah. No, I agree. So obviously, like I've said, it's easy for us to sit on the side. We investment professionals to a certain extent, but clients do go through in a period where it's not nice to go through experiences like this. And what we just want to say is that obviously markets tend to recover fairly quickly out of this. And I think it doesn't help us to sit here and make drastic changes when we know our portfolios are built for times like these. It's built for volatility in that sense.
Absolutely correct. Any client would have gone through a financial analysis process. A plan would have been put in place to assist their client meet their long-term financial goals. And in the implementation of that financial plan, account would have been made for market volatility. And that volatility would have been understood and expected during the course of a 10, 15, 20-year financial plan.
Yeah, I agree. So I think that was the one side. So obviously geopolitics, like we've mentioned, as a short-term influence. I think the other thing that's been very topical is this whole theme about AI, and it feels like we've been hammering on this drum for the last 6 to 12 months. Just how do you view at 91 the impact that AI is going to have on certain businesses, and how do you protect yourself against that? Just a view on AI, because I mean we've seen drastic changes in stock markets over the last 2 to 3 months.
So we would agree that AI is going to change the world, is changing the world. And it's not something that hasn't happened in the past. We've gone through the Industrial Revolution. We've gone through the introduction of motor vehicles. We had the internet in the early 2000s, and we've experienced the leaps in productivity that result from this change that is occurring. And we would agree that AI is likely to introduce significant change and improvements in productivity. And we would encourage people to embrace AI in their roles. And as a result, it's likely that some companies do come under pressure. If you roll back, there's the classic story about buggy whip manufacturers that didn't change their business model to producing tires for automobiles, and therefore went out of business. Those companies that don't have an enduring competitive advantage of one form or another, that have a significant moat that protects their business, are likely to get disrupted. But we would also take the view that there are many companies that will embrace AI, embed it in their organizations, and benefit significantly from it. And the challenge is obviously to identify those that are at risk and those that are likely to benefit from AI.
I've heard Bill Gates say that we tend to overestimate the impact in the first 2 years and underestimate it over the long term. And I think that fear that you've spoken about with regards to geopolitics actually filters through to AI and businesses as well. So we've seen extreme volatility in markets. An example, I read that Citrini research report, like the doomsday report of what AI will do to certain companies. And on the day, the stock market falls with 5, 6, 7%. So I just think coupled with what's been happening, markets go through volatile periods. We just want to reiterate that that's absolutely normal when it comes to investing. It just feels like when you're in that moment that it can be extrapolated into future, and markets tend to look through that, and you tend to recover and you tend to go on your journey. So Paul, I think that's all that I maybe just wanted to cover from my side. Thanks for your time. And if you have any questions, please feel free to reach out to your wealth manager.
Thanks, Wayne.